Good morning and welcome to this Monday, June 7th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got the start of another new week. Currently, we got futures a little mixed. S&P 500 up a couple, so we're going to try that breakout on to an all-time high again this morning. We struggled with it at the end of the day on Friday. Looked like we might barely eclipse it, and then we saw some selling just in the last couple of minutes. It took us beneath that level. Always bullish to see an all-time high. So that's one of the things we'll be watching today to see if we can get to that all-time high. Inflation, not really a whole lot going on in terms of economic reports. So we got inflation out later this week. And so I'm anxious just to see how the market trades ahead of this inflation report, because if you recall, back in May last month, right as we were getting the April CPI and PPI numbers, the market started selling off a couple of days ahead of that data. And then we continued to sell off into the CPI. And then when the PPI came out, we kind of bottomed and started moving back up. So it was a sell on rumor, buy on the news kind of a scenario. So I wrote a Chart Watchers article over the weekend and just said, hey, looking ahead, I'd expect to see selling because that's what we saw last month. But I think the numbers are going to be, the headline numbers are going to be very powerful. They're going to suggest inflation. And I just think it's up to what the media does with it, to be honest, the financial media. I don't think inflation's a problem, and I'm going to get into all that. I'm going to show you some charts here in just a couple minutes. But I think that this is absolutely transitory for a couple of reasons, and we'll go over that in just a bit. But before we get into any of that, let me take you over to Earnings Beats. If you are new to Earnings Beats, I do want everyone to know we've got a spring special running, and that will run through next week, next Tuesday. So you got 8 more days. This is our best deal of the year. So if you are already an annual member and you want to extend, this is going to be the best time to do so. Also, if you're new to Earnings Beats, if you haven't tried us and you want to try us, it's a no-cost 30-day trial. So you should try it now, because if you do like the service, you're going to save a ton of money by enjoying the spring special savings. If you're already a trial member and you decide that, hey, you want to extend, you get the rest of your trial period before the spring special kicks in. And basically the spring special is sign up for 12 months and you get 2 bonus months for free. So you're getting 14 months for the price of 12. And we already heavily discount our annual membership versus monthly membership. Monthly is 147, annual is 997. So if you take that 147 times 12, you're going to get like close to $1,800. But that's already discounted to 997. And then we throw on during our spring special an extra 2 months. So you get 14 months for the price of 997, which I think is a great deal. If you're new to Earnings Beats altogether and you just want to try to experience a little bit of what's going on, what we look at, what we do, I think the free Earnings Beats Digest would be a great answer. All you need to do is put in your name, email address right here in the boxes provided. Hit that subscribe button, and we'll make sure you get added to the list. It would also be important to do that because later today, we're going to be providing a room link to everyone that's in our community. So all of our members will get it. All of our Earnings Beats Digest newsletter subscribers, which is completely free, you'll also get this. We're going to invite you to an event later tonight. And I want to talk about the inflation impact, what kind of an impact this could have on the market, because I think the numbers, and like I said, the headlines, I think are going to be shocking. But what do you do? I mean, if the market begins to sell off, what are the signs that tell you, hey, inflation is the big story here? Because I don't think so far really that the signs are pointing to that. And this is going to be, in my opinion, the last big shocking report that we're going to get. I think next month, when we do the June numbers that get released in July, I think a lot of the way the numbers are going to flow through, I think that this is going to be the last one that's going to be shocking. So how the market reacts, I think, is going to be really important. But anyway, there's no credit card required for this new, free newsletter. You can unsubscribe at any time. So if you want to just come to the event tonight, you can sign in. And you can always unsubscribe if you'd like. We just want to get the word out to as many folks as possible. And this is how we're going to get the link out to everyone. So we want to make sure that, you sign up and you know how to sign up. All right, let's move on to what happened on Friday before we get into some of this inflation news and charts and things that you need to be aware of. So on Friday, we had the Dow Jones up 179 points, S&P 37, NASDAQ 200, mid caps were up 14, small caps up not so much, only a couple. But you can see all of the AD lines started to turn back up again, already strong on both mid cap and small cap, but everything else was turning up. The key and probably the biggest story for me on Friday was the S&P 500 trying to break out above 42, 32, 60, I think was the cents or the decimal points, 42, 32, 60, I believe. Anyway, we got up to that level on an intraday basis. I think we went over 42, 33 right before the close, and then we pulled back. Probably some program selling kicked in, and we ended up closing just below that breakout level. Now, if the S&P 500 can break out in the midst of all this hyperinflation talk, you got to be looking at the charts. And that's why we do look at the charts much more than we look at the data and the fundamentals. I mean, I could look at the fundamentals right now and say, wow, inflation, it's the highest it's been in 20 years. We should be petrified. That's what the data is telling me. The market is saying, we don't really care. Now, the growth stocks, I think, care a little bit, but it's hard to decipher with the growth stocks. Is it because they got so far ahead of themselves with rates low and, because their numbers were so much better during the pandemic? Is it just that they're pulling back, money's rotating because of that? Or is it inflation? And I don't know what the right answer is because it could be either or both. But if inflation numbers come out and the growth stocks begin to outperform, then I think it's pretty clear that the market is not concerned about inflation. Inflation eats away a lot of the future earnings. So if you're looking at valuations on growth stocks and the huge multiples that they can generate, you want to keep an eye on these stocks, because if they do start to sell off big, then it's probably because the market is more concerned about inflation. If they are shaking it off, then I think you got to pay attention to that, because it's giving you a signal that the market does not believe inflation is a problem, even though you might see headline after headline talking about it. It all comes down to the charts. That's where they're putting their money. Think about it that way. Do you care about what somebody's saying, or do you care what somebody's buying? I prefer what they're buying. I don't care what they're saying. Technology on Friday had a good day, up 2%. Communication services and discretionary stocks. These were your three leaders. They're the three that typically carry us during secular bull markets. And these three have not been carrying us over the past 3 to 6 months. Now, is it just one day? Are we going to break out? Well, you can see, first of all, communication services trying to make a new 52-week high. So that would be bullish there. Technology trying just to break back. We got above 140, which was the first time we've done that since we sold off heading into that last inflation report. So if we keep going up with inflation numbers going up, that's telling us this is probably very transitory. Now, if technology goes back down, then we've got some more work to do, some more research in terms of what's going on with the growth stocks. So watch technology, watch discretionary. Discretionary, the weakest right now among the three for sure. Went up to the moving averages, couldn't get through, rolled back over. Now we're below the 20, which is below the 50. So these are the three key areas, in my opinion. I think financials and industrials, obviously they're doing well. They're part of our aggressive sectors. But with interest rates more likely than not, in my opinion, to go higher, I think those two areas are going to be okay. It's really these three as to whether or not the market is ignoring growth issues, ignoring the inflation news, or is the market still embracing the high growth, low interest rate environment? And that's what we're going to find out, I think, here, not just this week, but really over the summer. This week is just kind of, I don't know, maybe a poster child of what's going to take place, simply because this, in my opinion, will be the last major headline story of inflation that we're going to see. That's, again, my opinion. Utilities, not so good on Friday. The only group to lose ground just lost a fraction, down 0.1%. Still in this downtrend, but it's pulled back for a while. I would expect utilities to hold around 64 at the low and then start to turn back up. But I don't believe this is going to be a leading group. Automobiles, best performing industry group on Friday. And the whole idea on Friday, what was kind of driving the market, in my opinion, is that inflation is not a problem. And the market was actually cheering the fact that jobs came in a little less than expected. They were still strong, so the economy's strong, but it was a little less than expected, which might keep the brakes on the Fed. I think that's the way the market was interpreting it. And so if the Fed is looking at this and jobs didn't come in as strong, maybe they'll continue to delay raising rates. And so that would impact positively these high growth areas. And that's why, in my opinion, we saw money rotating back in. Still a lot of work to do there. And I'm going to talk about that in just a minute. Let's take a look at the 10-year Treasury yield, get an update there, see what's going on. We had a rough day in terms of the yield on Friday. A lot of money moving into Treasuries because of that weaker than expected jobs report. And that sent the yield down. But I think we're just kind of going back and forth in this range. I'm not really paying that much attention to the 10-year Treasury yield until we either break below 150 or break above 175. And so today we're up a couple basis points, 1.5 basis points, back to above 1.57%, still within this range. And so I don't really see anything major. But while we go sideways, look at what's going on in the financial and industrial space. This is the XLF relative to the S&P 500. And down at the bottom is the XLI industrials relative to the S&P 500. And I think it's pretty clear on a relative basis, these two groups continue to do well. And even though rates are not continuing to go higher, we're still seeing financials go up. And that, to me, is telling me we're probably going to see rates move up. I think that's what the stock market's telling me. Okay. As far as economic reports, nothing out today. And really, the only major economic reports, of course, we're going to have the initial jobless claims on Thursday, as we always do. But that Thursday CPI report is really the only thing we have this week. That's what the market's going to focus on. There's nothing else coming out. Earnings are slowing down. No real economic news of substance coming out. So if ever there was a time when the stock market was going to focus on one key economic report, it's probably going to be this week. We're also moving into that period of the month where the market doesn't do so well, 7th to the 10th. I think in June it stretches to the 11th of the month, which is this entire week. So there's just a lot of things stacking up against the market going into this week. If we go higher, and the market has a history, especially during secular bull markets, to climb that wall of worry. If we can go up this week, that to me is really sending a signal that there's nothing stopping this market, including inflation. So I think this is a pretty big week just from a signal standpoint. Now, does that mean if it goes up this week, we're just never going to come back down? Of course not. But I'm going to feel a lot better about pullbacks if we can go up into this inflation data and then hold it after the inflation reports come out. That will tell me that this market truly, the professionals anyway, truly are not panicked over inflation. All right. Let's move on. So let's talk a little bit about inflation. When you go to stock charts, if you go into the symbol box and put in $2 signs, CPI, you'll get the consumer price index. And then what I do is I pull up a monthly chart because the data comes out monthly. So it doesn't make sense to pull up a daily chart. You're not going to see much action on a daily chart. Monthly, though, every month there's a change. Now, I've got it here in the candlestick form, even though candlesticks don't really matter. But you can kind of see the gap ups and gap downs. So if I went to a line chart, which would be fine, you could use a line chart. I do use it sometimes. You don't really see the gaps each month. So I'm going to stick with that candlestick chart because you see how rapid the numbers have gone up the last 2 months on the CPI. And if you look back a year, you see how we were going down. Look back over history. I mean, we don't go through many periods where the CPI goes down. And if you look at the core CPI, which is the dollar CCPI, you see almost nothing coming down. So the more volatile food and energy is what drives sometimes the short-term moves up and down. But when you go to the core and you strip out food and energy, you really kind of even things out. And that's why the Fed does this. A lot of people don't understand, like, well, how can you strip out energy? Gas prices are going up. Well, not that long ago, they were way down. It's like it's too volatile. Food prices are the same way. You go through a drought, all of a sudden food prices shoot up. So you want to strip that out just to get basic inflation data. So I actually like to follow the consumer price index, the core. And I think that's really what the Fed follows most closely. That's what they always talk about. But if you look at this, there have been only maybe a handful of times going all the way back to the 90s where we've seen the core CPI drop over any period of time. I mean, I see 1 month here and I see one, you can tell on here, I don't know if you can see it on your screen, but if you pull the chart up and you blow it up, you'll see a couple of little red lines where it goes down very temporarily. So you see one here in 2008, another one in 2010, and then 2017, we had one little dip. 2020, during the pandemic, we saw the core CPI drop 3 straight months. That's unprecedented. Well, when you're looking at the headline data, which is year over year, what we're now looking at is we're comparing these sudden surges in CPI to the drops that we had 12 months ago. And so it looks like inflation's taking off. But once we get past this period, all of a sudden, then we're going to start looking at CPI data versus the growing CPI data again. So we're not going to get this 3 or 4 month period of just inflated inflation numbers. And I think it's very temporary. Now, what would mean, well, how would I be wrong? Well, if you see CPI, core CPI going up for the next year, keeps going up 4, 5, 6, tenths of 1% every quarter or every month, yeah, that would be a problem. I don't think that's going to happen. I think after we get through this period, right now we're in a bubble in the economy, which is kind of working its way through. But the reason that we're going up like this is, number one, the economy is the strongest it's been in 30 years, 40 years. So all of a sudden we've got all this demand. Well, at the same time, we're coming out of a pandemic where many companies were not at full force because business was slow. So there was a supply chain disruption. Companies weren't manufacturing enough goods. And all of a sudden now we have this huge demand. So we've got that combination, which is sending everything higher, along with these very, very abnormally low CPI and PPI readings from last year because of the pandemic. And so when you look year over year, it's the combination of these two things. Look at what's going on. This is a 12-month rate of change at the bottom. So this is giving us the year over year. And the core CPI in the last 3 months has gone from 1.3 to 3. And after today, it's probably going to go up another 0.5%. I mean, we're probably going to be at 3.5%. So you can imagine anybody who wants to be an inflation, wants to really talk about inflation and push that whole inflation thesis, they're going to look back and say, this is the highest that core CPI has been year over year since back in the early 1990s, 30-year highs. Well, that's going to scare some people. Now, whether or not it's really something we need to be fearful of or not, follow the charts. Don't follow the headlines. Because what I believe is going to happen is we're probably going to see a little bit more movement to the upside in this rate of change. And then I think over the course of the next year, you're going to see it start ticking back down, working its way back down to 2.5%, which the Fed is fine with. And if there's no inflation problem, growth isn't a big deal. It's only growth. High growth is only a problem when the economy starts to overheat and inflation becomes a problem. So that's why it's going to be so important, because if this starts to turn back down, rates are going to stay fairly low, and you're going to see growth stocks take another big leap forward, in my opinion. This growth story isn't over. I mean, it was a rough period for us personally at earnings beats because our portfolios got hit one quarter. 3 of our 4. The one where we went a little bit more value oriented did much, much better, actually beat the S&P handily. So that's just giving you my take. I know I'm spending a lot of time on this, but I think this is really important from a long-term perspective. It's also important this week, but I think it's important long-term. And so what we're going to talk about tonight are what has happened in the past when we've had inflation. Like what happened in 2000 to 2002 when rates were going, or when the inflation rate was going up above 2.5%. What happened 2004 to 2006? You know, what were some of the similarities? What were some of the differences? What should we be looking for in terms of market performance, and what areas of the market should we be thinking about? Now, again, I don't think this is a long-term problem, but what if it does morph into it? What if I'm wrong? And what if inflation does pick up? I don't believe it's going to, but that doesn't mean it won't. I could be wrong. So what should we be looking for? Those are the things we're going to be talking about at our special event later tonight. So make sure, again, if you haven't already signed up, do it pretty soon, because we'll send out room instructions later to our Earnings Beats Digest subscribers and all of our members, obviously. I'll try to remember to send something out with the daily market report, or we'll have a separate email, that sort of thing. All right, so anyway, this is what's going on with the inflation right now. And I think that this is going to be a focal point this week. But what does the market do? Do we sell off again like we did in May ahead of time? Or because we've already rallied back from that low, is everyone looking past inflation? We're going to probably find out based on how the stock market trades this week. If inflation's a big problem, I cannot imagine all week we go higher while inflation comes out and, you know, these numbers keep going up, because they're going to go up. This isn't a question of whether they go up. They're going up. Inflation, the number on Thursday is going to be shocking. The PPI on the following Tuesday, it's going to be shocking. It's going to be the highest numbers we've seen in a long, long time. So what does the market do with that? I think that's the theme here. All right, let's move on. I actually did a chart. I think it was in the weekly portfolio report that I sent out to members, I believe. I don't even remember. I write in so many different, or actually maybe no, I actually think I put this in the, I think it was my last Trading Places Live blog article on Saturday that I wrote. So this particular chart was not in there, but I'll show you one that was. The first thing I want to show you, though, this is pretty cool. When you look at relative rotation graphs, you can really get a good sense of how everything is rotating visually. Julius de Kempenaar was the creator of this, and I think this is brilliant. But essentially, you're looking around an axis, and whatever your benchmark you use, that's kind of your axis, which is the center point. So I'm using the S&P 500. What you can do is you can watch to see how different stocks or ETFs or asset classes or whatever are moving relative to your benchmark throughout these 4 quadrants: leading, weakening, lagging, and improving. Now, you might think that they just tend to just go like this. Usually they don't. Normally what will happen is that the leading areas will go into weakening, and then they'll start to lead again. So it's like they stay on the right side, which is the relative strength side. This side over here is relative weakness. And then if you're looking from top to bottom, this is strong momentum. This is weak momentum down at the bottom. So if you're moving up and into this leading quadrant, what you're seeing is momentum soaring and relative strength. And that's what you want to see. You want your, you know, when you're trading, if you're a short-term trader, you really want to see your stocks or ETFs or whatever over on this side of the chart, because this is relative strength. And when you lose momentum in relative strength, a lot of times that's when you want to jump back in right before it starts to lead again. But anyway, I want you to watch. I'm going to go back a year. This is where we are right now. So value's been weakening, growth has been picking up, but notice value still on the right side of the chart, relative strength. Growth is still on the left side of the chart, relative weakness. Now let's go back a year, and I want you to look at where we were. Here's growth and here's value. So it was the opposite a year ago. And watch what the IWF was doing on the right side of the chart. This is growth. Okay, so value is coming over and starting to lead. And look at the IWF start to turn higher. And it looks like they were going to go and growth was about to lead again. This was starting 2021. This is where it looked like growth was about to lead again and value was coming down. And then watch what happens. They took a complete turn, and now we're here. So as I talk about inflation and we're, constantly looking at growth versus value, I think this is a really cool chart. And each one of this line with these little dots, these are tails, and tails are just each week is one tail. This is a weekly chart. If it was a daily chart, each tail would be one day, but you can change the length of the tail to kind of see where something has been coming from to where it is now. So it's just kind of retracing your steps, if you will. And then you can shorten the tail. If you don't want to know where it's been, you can just do 1 week for the tail and you just see what it did in the last week. But again, here, then you can just kind of show what has been going on throughout this entire period. So anyway, I think it's kind of cool. Now, what I wrote in my blog, whoops, oh, there it is. Okay, I knew I had done it. Okay, so here's what I put in my blog, which was the S&P 500. And then these are the 10 biggest components of the IWF, which is growth. 10 largest components. These 10 components, you know the names: Microsoft, NVIDIA, Google, Apple, Tesla, MasterCard, Visa, Facebook, Amazon. Those 9 stocks make up 45% of the IWF that we were just watching. So this is where it's at. These are the stocks. Now I want you to look at where we were a year ago. All 9 stocks were on the right side of the S&P 500. All were outperforming. Then we started to see MasterCard and Visa pull back. These are the 2 in the red. But as I go through the year, just notice how they just start to move more and more. You got Tesla way over here, the huge outperformer, and then it became the huge underperformer. But notice as we went into 2021, look at what's happening. Most of these leading stocks in the IWF are starting to move on the wrong side of relative strength. And it looks like they're all strengthening here in January. This actually is in February. So this is when we had to do our last draft, by the way, February 19th. So we're looking at all these growth stocks really starting to work out. And then literally there's February 22nd. And then look at everything just kind of changed. Look at how many stocks went way to the left of center, including Tesla, Apple, Amazon. And then you had a couple of the internet stocks, Facebook and Google doing pretty well, Microsoft hanging in, NVIDIA okay. But you can see a much different picture here at the end of this versus a year ago. And that's what's been taking place. I just thought this was a great way to show it. And then, of course, this is the IWF, IWD. So we just saw the rotation and how things really turned down in February. Here's the ratio, IWF to IWD, that shows it on the chart. So I'm more of a numbers person. I still think the ROG is really cool to visualize, but I'm a numbers person. So I think these numbers really mean something to me. So I'm looking at 1.69 as a key resistance level, relative resistance level. And if I pull up this and annotate this, you see all these lows here at 154, here at 155, here at 154 and change, 155. I mean, you can kind of see this is an area that's been really good support on a relative basis. We don't, if inflation is a big problem, this level of support should be lost. If we get those big numbers out with inflation and I see this going higher, that's going to tell me that market doesn't care about this inflation. This is temporary. There's no reason in the world for professionals to be putting their money into growth stocks if we're seeing huge inflation numbers and inflation is going to be a big problem down the road. So all of this ties together. And that's what I kind of wanted to go through today, and just so that you have an idea of some of the things we're going to talk about tonight. Now, again, I'm going to go into many more specifics as to areas of the market, but I think you can kind of get a sense, hopefully, of how big these next couple of weeks are. The market historically in the middle of June doesn't do well. The last, I think, 11 years, we've gone down 6 of the 11 from the 7th to the 25th or the 6th to the 25th. But in 2 of those 6 years that we're down, we went down more than 5%. And I think of all 11 or 12 years, only one of them went up more than 2%. So this is not the time of the summer, time of the year where the market tends to do very well anyway. And we've got this inflation story coming. So it's just, I'm looking at the market and I see, okay, 52-week highs, but, so it's sunny. I'm out on the golf course, but I look and I feel like I see like a tornado in the distance. And is it coming my way or not? That's kind of the analogy I would give looking at the market right now. It's sunny, but we got some things way over in the distance. It looks like it might be headed our way. And I think this is one chart that'll tell you whether it hits us. All right. Earnings, not really much out. I'm going to make this really quick. This will be one of the 3 you must see. So G3 reported this morning. They beat easily. Let's take a look at what actually market just opened. So let me see if that's the latest. Oh, here we go. So we opened up with some good news. This is a stock actually that's been doing very well relative to clothing and accessories. And this is a group that I wouldn't be surprised to see bounce, clothing and accessories. And so this is a leader. I'd watch for this breakout. And for me, the breakout would be, let's see, the high is there, 34.60. I look at candle bodies, not the tails or the shadows or the wicks, but the bodies. So this was 34.60. Just seeing if anything is 34.49, 34.49. Yeah, so 34.60 is breakout to me. If we get a close over 34.60, then I think G3 Apparel Group is breaking out. AD line looks good. I mean, the chart looks good. Numbers were good. We'll just see whether or not stock makes the breakout. The last 2 I want to give you, these are 2 stocks that were horrible or have been horrible, in my opinion, the last few months, but were great last year. 2 leaders, growth leaders. If you were following growth stocks last year, you couldn't help but notice what was going on with these 2 stocks. They were stay-at-home winners. First one is Zoom. Zoom had a good day on Friday. I know it was down in the pre-market. Yeah, down a little bit, not much, down $1. But it is now starting to bounce off of its 20-day, which has now climbed above its 50-day. I would definitely keep Zoom on your radar. If growth starts to move into a favor, this is a company that just blew away their earnings. I think it was $1.30 something versus 92 cents. And they raised their guidance, top and bottom line, not just the upcoming quarter, but for the year. If growth gets back into favor, this is the kind of stock I think that'll do really well. And then DocuSign, look at the huge day it had on Friday. It's continuing that, trying to make this double top breakout. If it closes above it, I mean, if I was trading it, I was in on the long side, I would just wait to see if we can close above this. If we fail to close, we move back down below 230, I'd probably just take a small loss and just figure, okay, it's not time yet. But this could break out and move straight back to these highs. These stocks, these growth stocks, when the money really does start to move back into them, we know how fast they can move. And they've been going sideways for a while. Last one I'll give you is Amazon. Amazon has been sideways consolidating ever since that early September high. And I remember that was when I wrote a blog article, not about Amazon, just about the overall market. That was I think one of the biggest warning signs in the market was back in early September. You go back in the archives and read my article. But I think it was on September 3rd that I posted, hey, this market looks like it's cooked to me in the near term. And it's actually many of the growth stocks have struggled since that time. You can see there a failed breakout attempt. But this long consolidation period, while very frustrating to a short-term trader, is very bullish from a long-term perspective. This is going to allow Amazon, in my opinion, to really move when it breaks out. And you'll know when it breaks out. It's not going to be, playing around with this 3,550 level. It's going to just go. You're going to see 3,600, 3,700. The volume's going to pick up, and it's going to be off to the races. So if you got the patience, buying on weakness, I think makes sense because I do think growth is coming back. But again, am I wrong about inflation? I could be wrong. I don't think I am, but we'll see. We're going to find out for sure. Anyway, that's all I got for today. Let's get a quick look at the market, see what's going on here. NASDAQ down 14, Dow up 32, and here we are at the S&P still 42.30, 260 is the level. I can't make this stuff up. Here we are, 42.30, 112. Just sitting here. I don't know what's going to happen. Again, I think it's a bullish signal if we make the breakout, or maybe it's a false breakout today, and then we start seeing a big sell-off the next couple of days heading into inflation. I don't know. I don't know how things are going to work out in the short term. You know, the short term to me is always very difficult. I would be a seller if my stock was testing highs right now with this inflation report coming out later this week. Personally, if I'm a trader. Now, if you're buy and holder, then just put your blinders on and forget about everything going on. But if I'm talking about as traders, if you're up against key resistance and you've made some money, I would at least be taking something off the table, or worst case, maybe selling calls against my position, covered call strategy. So if at least if it comes down, you've taken some money off the table, you know, you'll be able to just take that call, you know, money you sell on the call and just put it in your pocket. Anyway, that's it for me. Everybody have a great day. I'll be back later today for that special event on inflation. So make sure you sign in. Again, go to earningsbeats.com and make sure you sign up for our free EB Digest newsletter if you haven't already, and we'll send you a room link. Or if you're a member at Earnings Beats, we'll make sure you'll definitely get that link later today. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. It'll be the recorded version. Hopefully we'll get back to live shows over there in time. But that starts tomorrow morning at 9 a.m. Stock Charts TV. So everybody have a great day. Hopefully see you tomorrow or maybe tonight. Take care, everybody. Happy trading.